WTI prices started rising since yesterday, yet the overall movement is still unconvincing for the bull's intentions. In the current report, we intend to have a look at the state of the US oil market, yet also, on an international level, discuss factors on the demand and supply sides that drive oil prices. To conclude the report, we will also provide a technical analysis of WTI's daily chart. The metrics related to the US oil market tend to provide mixed signals since our last report. Characteristically, the Baker Hughes oil rig count for the prior week dropped by 7 active oil rigs from 506 to 499 in a sign of easing oil demand in the US oil market. Furthermore, on Tuesday, the AP weekly crude oil inventories figure was released, showing an increase of US oil inventories by slightly more than 500,000 barrels, in another possible signal of easing oil demand in the US oil market. Yet both were contradicted by the release of the EIA crude oil inventories report that showed a drawdown of minus 1.362 million barrels. Overall, the EIA release, in contrast to AP, tended to imply that aggregated oil demand in the US surpassed oil production levels and implied a relative tightness at the current stage. Should we see the indicators aligning in the coming week, implying a tightness in the US oil market, we may see WTI's price getting a boost. On the international demand side, China seems to be regaining some ground. There were extensive reports for a rise in Chinese oil imports last month. According to Reuters, crude imports in April totaled 44.72 million metric tons, or about 11.88 million barrels per day, according to data from the General Administration of Customs. That represented a 5.45% increase from the relatively low 10.4 million barrels per day imported in April 2023. The increased demand for oil was also accompanied by improved trade data for the same month, as China's trade balance rose from $58.55 billion in March to $72.35 billion in April. In addition to that, both the import and export growth rates escaped negative territory, showing expansion in different degrees. Should the two be combined, it could lead to the assumption that healthy increased economic activity led to higher demand for oil in China, allowing for a more optimistic outlook for the Chinese oil demand in the future, which could support oil prices in the coming week should additional clues point to that direction. On the supply side of the international market, we tend to note the rising tensions in the Middle East as a possible factor that could strain the supply chains for the commodity. The first issue would be the Houthi actions, as they were reported to have been targeting ships in the Gulf of Aden. The key takeaway here is that the Houthis are once again targeting passing ships, threatening a key oil supply route, and market worries for possible additional strain on oil supply could start supporting oil prices. The second issue in the region would be the assault of Israel on the Rafah region of the Gaza Strip. A major Israeli military operation could cause thousands of victims, and if that's the case, then we may see reactions not only by Hamas, but by Iran itself for a second time. Such a direct involvement of Iran would signal an escalation to another level for the conflict and could provide also support for oil prices. WTI's price bounced on the 76.7 support line yesterday and corrected higher. Yet the rise of the commodities price, as viewed from our side, is a mere correction higher, given that the RSI indicator had reached as low as a reading of 30 before bouncing, while the price action also bounced on the lower boundary of the downward channel, currently leading the commodities price action. Furthermore, we note that the correction higher was marked after the price actions flirt with the lower Bollinger Band, creating some new room for the bears to play. It should be noted though that the RSI indicator has risen, yet is still below the reading of 50, implying an easing of the bearish sentiment. Overall, we tend to maintain a bearish outlook for the commodities price action, as long as its price action remains within the corridor set by the pre-mentioned downward channel. Should the bears actually remain in charge of the commodities direction, we would expect it to form a new lower low, hence we may see it breaking the 76.7 support line, thus opening the gates for the 72.85 support barrier. For a bullish outlook, we would require WTI's price action to break the upper boundary of the current downward channel, signaling an interruption of the downward movement, breaking the 80.25 resistance line clearly, and start aiming for the 84.10 resistance hurdle. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.